Let's start with the big market moves, though, and that continued fallout from the block sales stemming from hedge fund Archegos. Sector-wide, we are seeing financials bouncing back in the session today after coming under pressure yesterday. Media companies also in focus on the back of that event. Let's bring in Dana D'Auria, Envestnet PMC co-CIO. Dana, it's good to talk to you today. Let me just get your take on what has transpired over the last several days as it relates to this particular hedge fund and the market moves coming from it.
Yeah, certainly. And thank you for having me. I would say, at this stage of the game, everyone's trying to figure out what the whether or not this is a systemic problem or kind of just an idiosyncratic issue related to certain banks that were working with this hedge fund. So, and I think what we're seeing now, it's been obviously something the market's been working out for the last couple of days. But I think what we're seeing now is that it does seem to be confined to certain banks, at least the way it looks at the time. So we have certain banks actually up versus obviously Credit Suisse, and others are warning that this is going to mean a hit to earnings. So the good news is I think markets are parsing this and determining who's going to take a hit and who isn't.
Yeah, it seems relatively constricted to just those banks involved. But when you think broader outside this fund, obviously it raises questions about margin calls and leverage right now. Reports that this fund was using about 6 to 8 times leverage. And you wonder how many other funds out there might be caught in something similar. So, I mean, in terms of the speculation that got us up to these levels, on the flip side, if we saw things deteriorate rather quickly, I mean, how much maybe system-wide risk do you expect to see from something like this start to trickle out over the next couple of weeks?
I think that, and that's actually exactly what the market is trying to figure out. Are we having another Lehman moment here? As I say, I think at this moment, from what it looks like, it is relatively confined. We're already seeing certain bank shares up, but it's interesting that they did have that position and that they weren't taking profits earlier. And it does, sort of start begging the question again. We've seen this before. Is there a systemic risk that we need to be concerned with? It's something that the markets will have to obviously parse out over the course of the next days and weeks. So I'd say, cautiously optimistic that right now it is relatively contained. But these sorts of things have a tendency to kind of develop and sometimes find linkages that maybe weren't immediately evident. So it does remain to be seen.
Dana, let's talk about what we're seeing play out in the bond markets. When you look at the yield on the 10-year T-note, coming off of what we saw earlier in the session, but it is still above 1.7%. There's a lot of debate about what this actually reflects, whether it's about real growth expectations, inflation concerns. Which side do you stand on?
I definitely, so I sit kind of at the junction of a lot of different economic intel, just based on Envestnet's platform. And I can tell you, I do see differing information come in on that. I mean, there's certainly an argument to be made that with the stimulus that we're seeing, the market is concerned about inflation. The Fed obviously is kind of holding firm on this idea that inflation right now is global, it's slow moving, it's not a concern. They're very focused on unemployment, and they're not going to respond. I think the market is testing that, and certainly there is concern about inflation. There is concern about as we move to reopening, and we also obviously are getting these stimulus checks in the mail in March. There's just a lot of money in the system. Do we have to be concerned about this? So. High level, I mean, certainly 10-year yields, I think, are still in the grand scheme, not really that high, right? 1.7. It's really just the speed at which this has happened that I think is upsetting markets.
How do you think that investors should be looking at the mix between equities and fixed income, given what you just mentioned? Does the traditional 60-40 ratio still hold, or you think that it's time to maybe tweak that mix, just given the moves that we have seen in the bond market?
Yeah, it's a great question, and it's definitely one I think advisors are focusing on right now because the balance 60/40 has come under some assault, and certainly in a we've had for years now a pretty low yield environment. So if you're investing in a 60/40, you're taking 40% of your assets and putting into something that is not going to yield a heck of a lot over the course of the horizon, at least in the near term. Now, of course, we're looking at an experience for investors where they've actually sustained losses in even the ag, right? So several hundred basis points in losses, and I think that's going to be an interesting comeuppance as we hit quarterly reviews and people look at their statements and they say, not only is this position not earning a heck of a lot, but I'm now actually negative on my bonds, that this is not the, kind of flat, at least risk reducing asset class that I might have thought it was. So I do think that advisors are looking at and asking the question, can we diversify that standard 40% bond position? Are there other asset classes we should be looking at? Maybe it's alternatives. Obviously, if you're working with accredited investors, you have options such as private credit or private real estate. If you're, if you're mass affluent, maybe you're looking at liquid alternatives as a way to diversify that standard 40% bond position.
Dana Dioria, Envestnet PMC co-CIO. Good to talk to you today.